We are pleased to be joined by Yashu Sharma. Yashu, thanks so much for joining us. Markets obviously crashed pretty hard yesterday, continuing a stream of red in December. So you had a lot of kind of macro concern on the monetary policy side related to kind of interest rates rising, which of course hurts growth stocks. So it's kind of strange that markets were falling on that concern, and then if you're concerned about that, you should really not want the bill to pass, right? Because that stops kind of deficit spending from increasing. It's kind of confusing to me, or just strange that markets are falling kind of on both sides of this line, this tightrope walk that the federal government's been pulling here.
It's unprecedented territory where we're sitting at with how much money is being printed, with cryptocurrencies now on the forefront of everyone's mind. We don't have a roadmap of what's kind of ahead. The amount of M1, M2 in the market is it's absurd. But if you look at where that money has to go, it has to go somewhere. It's not going to be sitting around. No one is prepared to fully grasp all the nuances of and figure out every single answer to a T. But I guess that's what makes our kind of videos exciting, is because we can, hypothesize on these sort of things.
So you've got this new paradigm that's uncharted, and you'll need new formulas and new kind of theories to survive in this new world. One of the things I haven't heard people talking about too much is, kind of the potential for window dressing and some tax loss harvesting and that sort of thing.
After quadruple witching is usually when I start talking more about window dressing, just because a lot of the funds rebalancing is kind of out the window now. We don't have to worry about that. Contracts have been rolled when it comes to futures. Perhaps that's what we're seeing today with Tesla up 1%. But that being said, it's still underperforming based on the market. I think with the alpha that has been generated by Tesla from the beginning of quarter four to now, I think it's probably a decent enough chance to hypothesize that there's going to be some degree of window dressing if it hasn't happened already.
The other thing that does tend to happen, especially this time of year, is tax loss harvesting. It seems like there's some cash kind of sitting on the sidelines.
Even though I think we're far and away from where we were in March 2020, I think people can't help to have some PTSD. So I think you're right. There's a degree of just pool of money that's waiting for like a huge amount of blood on the streets before they're going to come back. Whenever we get ripped off the top on a green day, I think everyone's immediate reaction is, okay, Elon is selling.
To me, it doesn't seem likely that he would quote that specific figure if he was potentially going to be selling some more shares.
That's exactly what I thought was, why would he tweet that if he had more to sell? If you zoom out 5 years, if you zoom out even a couple of years, like this stuff is going to be non-material, I think, to the narrative of Tesla and how fast it's going to be growing product wise.
I'm more and more convinced that we need to close our minds a little bit to the kind of short-term pain. Don't check your account balances on a day-to-day basis, and more so just kind of focus on the operations and what you think the company is doing to execute. Can't help but be, incredibly optimistic. And I only wish I had more dry powder personally.
I think Wall Street is trying to hold back and temper back expectations until they start seeing cars being put out.
I think you're going to see the same thing happened in 2020, where like there was just like this race of analysts kind of raising price targets and raising earnings estimates just because like they had to.
1% increase in interest rates would definitely dampen valuations for sure. How much of that is being priced in, given that we know that there's likely some interest rate hikes to come already?
My main contention is that, the forward earnings estimates of like $8 and change are way too low for next year.
Yes, in March and April and May of this year, we did see weakness back down to the 200-day. But I think what's different this time around, mixing technicals with fundamentals, is that we didn't have 2 new gigas coming out. Once margin starts to really skyrocket, I think instead of optimizing for profit, they're going to bring down ASP. What's to say that Tesla just doesn't give back the cost and lower the margin and just grow delivery count?
I think you've seen this in China to a certain extent, where like there hasn't really been a backlog to speak of